In 2024, equity markets have been stumbling out of the gates as we start the new year. That's as investors weigh everything from U.S. economic uncertainty, the outlook for rates, a new Trump administration taking office, with, of course, trade and tariffs top of the agenda. So what should investors be thinking about when it comes to asset allocation? Ben Gossack is Managing Director and Portfolio Manager with TD Asset Management and one of my favorite people, and he joins me now. How are you?
Great. Let's not tell the other favorite people.
We won't tell them. We won't tell them. It's great to have you here, and one of the reasons you're one of my favorite people is because you bring charts, and you know how much I love the charts. So we'll get to them in a second, but when you look at the markets right now, again, incredible 2024. Not so incredible 2025. Things have kind of cooled off a little bit, but what do you see?
Yeah, so we'll call it two incredible back-to-back years, 23, 24. We're probably 5% off the highs, but if you were to talk to people, you would think we were down 20% off the highs. There are some stuff going on. I think you brought up the tariffs, new administration, but we also have a very strong U.S. dollar, and we've seen rates, even though we've been in a rate cutting environment, we've seen the yield curve lift off, and there are still some inflationary pressures that are pushing through the system. So I can understand why people are a bit hesitant and almost like waiting for specific dates to decide, like, we'll wait for the 20th and then we'll have inauguration and then I'll know if it's safe to get back in the water.
Right. And I think what actually probably a lot of people who have not liked this rally is they've been waiting till it's safe and then they've missed an extraordinary rally, as you mentioned, over 23, 24. So it's been pretty big. One of the questions investors often think about their portfolio is bonds versus equities as they try and diversify well and to manage things. You've got a bunch of charts. The first one we're going to look at is a chart, and tell me what we're looking at again. S&P 500 and U.S. investment-grade corporate bonds. What does this tell us?
Right. So my background was in engineering. I didn't grow up being a portfolio manager. I always thought, we rotate around the sun. Some really smart people sit around the room. We forecast how we think equities are going to do. We try to figure out the rate cuts, inflation, and we come up with a performance for fixed income. And that's how we should set our asset allocation, specifically in balanced funds. And I do manage a balanced fund. And what I wanted to do was represent, let's say, the tension between equities and fixed income. This is not a performance chart, it's a ratio chart. And it just tells you that what you've already known over the long run, which is that equities tend to outperform fixed income. So think of it as a fraction. Our numerator is the S&P 500. The denominator is the U.S. corporate bonds, so investment grade. And what it's been telling you is that over the course of time, it's been better to have more weight allocated to equities than to fixed income. Not that you shouldn't have it. The other thing that I would like to to sort of express with this chart, we rotate around the sun, and then we think like that must mean because we reset the books to zero, there must be a new trend that we need to look at.
It's an artificial line. Yeah.
And the new trend, unfortunately, is the old trend.
Yeah.
And you can see that this is something, we've been on this pathway, I'd say, even prior to COVID.
Let's take a look at the Canadian version of this. You've got the S&P TSX 60 versus the Canadian Universe Bond Index. And again, so when you look at this one, we see a similar story.
Yeah, and that's it. So that plays out in the U.S. and in Canada, and I manage a very large tactical balance fund.
Yep.
So again, this is just showing you that tension. While we have seen interest rate cuts, it has been more beneficial to the equity markets, and we've seen that outperformance of equities over fixed income. Again, not that fixed income should not be a part of your portfolio. People should work with professionals, and they provide a certain vehicle in terms of your outcomes. But in terms of investing for total return over the long run, that has told you to bias your portfolios towards equities.
What's this next chart show us? Because it's comparing, let's go to this one. Yes, sorry, U.S. equities versus, I assume, Canadian equities. So S&P 500 versus the TSX 60.
So when I think of the big questions, it's always equities or fixed income. The next big question, top of mind for most people, is do I put money into U.S. equities or Canadian equities?
Yeah.
I always have a stock answer, Kim, and that's always yes. It's always been the S&P 500. And I think people can see this. Again, we're showing you the tension between the S&P 500, the TSX 60. There have been times where they move together, and that's when we see the line go horizontal.
Right.
But over the long run, you've been better to be biased to the U.S. Now, having said that, I do manage a very large North American dividend portfolio. And while I'm aware of these macro trends, at the end of the day, I am a bottom-up stock picker.
Yeah.
And so relative to my benchmarks, I actually have more Canadian content. So I'm overweight Canada versus where the benchmarks are set. And that's because there are specific things unique to the Canadian market that you can't find in the U.S. market.
Can I pull up that chart again? We've got the, if I could, the U.S. Canadian versus Canadian equities, because what's interesting is when it goes horizontal. Like, just remind me, what was going on there? Is that like, was oil doing well? Were Canadian financials doing well? Like, what was the reason for that?
Yeah, so when we go sideways, we're coming out of that COVID bull market, and our Canadian banks particularly caught fire.
Okay, good. All right, just trying to remember that.
And
okay.
caught fire in a good way.
Yes, I was going to say, yes, went up. Okay, let's look at the same idea when you're comparing U.S. equities versus global markets, and this is versus the MSCI World Index.
Yes, and I also manage a global fund, and so...
You do a lot of stuff.
Yes. And so, oftentimes people will look at a global fund and they'll say, well, it's a lot of U.S. content. And I want to say that doesn't happen by accident. If you're benchmarked against the MSCI World, so you're exposed to the U.S., Europe, Asia, it just tells you that the winners, for the large part, for the most part, from a country perspective, have been coming from the U.S. Again, having said that, there's incredible content and unique assets that we would find, particularly, let's say it's European financials or European industrials or European luxury, Japanese defense companies, insurance companies. You can't just find that in the US. And so I think from a global product that I would build, we would have big weights to those specific stocks. But I think oftentimes, again, start of a new year, we look at valuations and all of a sudden, Europe is looking really cheap or certain other geographies. In the long run, it has paid to stay with the US over the rest of the world.
Okay, fascinating. Let's take a look at the Canadian financials, because this is the only chart that we've got so far that's not going directly up and to the right. So again, this is what? This is Canadian banks over the TSX 60?
Yeah, so oftentimes it's going to be, what's the asset class question?
Yeah.
What's the country bias question? US versus rest of the world. And then top of mind, I think for most Canadians, is what about our Canadian banks? What we're looking at is an equal weight Canadian bank index. So we treat all 6 banks as the same weight. We put it over the TSX 60. And if I told you that Canadian banks were cyclical, your eyes are not deceiving. There are periods of outperformance, underperformance. Most Canadian banks have been underperforming since 2022. And you asked that question about what was helping Canada. Well, you can see Canadian banks were on fire in a good way from 2020 into 2022. It wasn't until the central banks were moving to a cutting mode. This is sort of that November 23 that we've seen Canadian banks start to outperform. So Canadian banks outperforming really good. I get a lot of questions about tariffs. I think I contribute just as much as anyone else to this discussion. I don't know what those implications are. But I do believe that information is in the prices of assets. And we'll find out what happens in the next coming weeks. But if there was something in those tariffs and those threats that was going to be disastrous to the Canadian market, I would have expected that our Canadian banks would start to underperform the TSX 60.
Right.
And the fact that they haven't, including all Canadian financials, US financials, European financials, Japanese financials, tells me that that's part of more of a negotiating tactic for now.
You set up an excellent foundation for these next 3 charts, because it's a bit of a what now. So let's take a look at this one. And this is equal weight discretionary over equal weight staples. And this is, you're going to tell us whether this tells us about the equity rally and whether it's going to keep on going.
Right.
What does this say?
So what we're looking at here is basically people's wants versus their needs. This is like a risk-on, risk-off indicator. The reason why we go equal weight is because Amazon and Tesla, right now on a market cap basis, make up most of the discretionary index. And so if someone were to say, the market's fallen 5%, it's all over, I would bring up this chart and say, it looks like the consumer is still spending, still strong, picking and choosing, obviously. But this would tell you that the environment is a risk on. I have other charts that would back this one up, but for now, this is telling me that it's still safe to be in the water.
Fascinating. Wants over needs. I love that. Okay, the next one is we're taking a look at U.S. high yield versus U.S. Treasuries. What is this, similar, like risk?
This would be another similar sort of risk on, risk off indicator.
Yeah.
I manage equities, I manage balance funds. Sometimes I like to dabble in the fixed income market. Most people would show you some type of spread between high yield and Treasury securities. This is my way of doing it, looking at the high yield ETF versus Treasuries around the 3 to 7 year range. To me, that matches the duration. And what this tells me is that it's still biased towards high yield, which means that it's still a very risk-on environment. You can see in COVID, when things got scary, that this chart plummeted and people went to safety. But I'd argue since COVID, there was a little bit of a pullback in 2022 when we had that sell-off, but it's been biased towards risk-on. So you can build, I would say, a foundation from many different charts, but whether I look at the wants versus needs in the equity market, I look at the risk on, risk off indicators from the fixed income market, it's still telling me it's a risk on.
Interesting. Okay. The last one you have here, a 2-for-1 here. Are these all in the same chart we're going to look at?
So we're looking at the same stocks, but on the left, we're looking at them on a market cap basis, and on the right, we're looking at them on an equal weight basis.
Okay.
So I think most people would say, well, the only reason why the markets were up is it must be driven by those tech stocks and those Mag 7. I have always had trouble with the Mag 7 because I think it's been a bigger and broader equity market rally. But the takeaway that I get when I look at this chart on the left-hand side is that equities or technology specifically has moved with the S&P 500. It has not led it. It has not detracted from it. And when you look at it on an equal weight basis, so we get rid of the effects of an NVIDIA or a Broadcom or an Apple, you can see that the average stock coming from technology is like starting to uptick again. So I'd call 2024 sort of a basing year for technology.
Basing year for
basing
NVIDIA.
year for technology.
Wow.
And it could be setting itself up to drive the markets higher into 2025.
Yeah. And I know, like, again, as a, obviously a professional, like, this is all about probabilities and taking a look at kind of where things are. It's incredible, though, I think, for a lot of people to think that, 24, at how much it was up, that it's a basing year, right?
Well, I think for most people is that we saw semis run up into August of last year and then have just perennially underperformed or just consistently underperformed since August, only now starting to sort of turn around.
Yeah.
And so, yeah, I think when people talk about the Mag 7, it just takes up all the vacuum in the room.
Yeah.
We could show you charts on industrials, financials, you name it. They still continue to work and take the market higher.